So it's been a tough go for bond investors for a number of months now. And look at the aggregate index since August, which is a low in yields. It's down about 12%, quite painful. And the sort of the metaphor I like to think about in terms of where we are on this in this market is that I think about a staircase. We're on a staircase that's rising up, and we've just completed that first step. And that first step is the toughest. What we mean by that is we've increased our yield now. Our yield now is at a higher level, which is a good thing. Starting out with a higher yield makes life a little bit easier going forward. It still requires, we think, active management, thinking about the interest rate risk that's still out there, but also some of the other factors that are emerging in terms of the, when you start getting to the credit space, in terms of the potential for a downturn. So we're navigating those two areas, but we think now you're starting with a higher yield and you can start to enter into these markets more confidently. Now we're looking forward and we're saying the coast is not completely clear. On one side, we have still some interest rate risk out there. Treasuries have adjusted for a lot of that, but there's still inflationary concerns that are out there. We can't be completely confident that inflation is really going to roll over or that it's not going to remain sticky even at a lower level. So that's part of the concern. On the other side of the ledger, if you're looking to get more yield, which is always important in bond portfolios, and you look to the credit side, you have to start worrying about the tightening of financial conditions driven by the Fed and the possibility of a downturn or a recession coming in, say, 2023 or 2024. It's not clear yet, but certainly the odds are rising. So you have to have some caution in terms of how you're constructing a portfolio as you go forward. I understand investors may feel shell-shocked right now, and they may be looking at the risks that we talked about and being a little bit unsure. But right now, it's actually possible to build a very resilient bond portfolio. So we can currently build a portfolio, and that portfolio would have characteristics that include, say, a 2 to 3 year duration, an average investment grade quality. It would have some investment grade bonds, maybe a smattering of selected higher quality, high yield names, and perhaps some securitized bonds in the mix there. So it requires a degree of flexibility in the mandate, but you build that portfolio, it's going to hold up very well, we think, in the what we think is in store for the markets. So looking at that opportunity set that we laid out, we're looking for bonds that have a maturity somewhere between, say, the 2 to 5 year range. That's kind of the sweet spot right now. And for that, for investment grade, high grade, you're looking at yields of high 3%, maybe even into the mid 4s. And then as you go down into the upper end, the upper quality of the high yield market, you might be able to get, or certainly could get, something around the 5 to 6% range. So essentially, this is a pull to par strategy. What do we mean by that? So we mean that as a bond gets closer to maturity, it becomes less and less sensitive to the general level of yields that are out there until eventually it matures at par. And so right now, by building a portfolio that's lower in that duration range, it is much more resilient to rising yields, whether it comes from inflation worries and higher treasury yields, or whether it comes from the worries about spreads widening further on downturn concerns. For example, I was looking in the market the other day, and there's plenty of opportunities out here, but one example was a high single A bank, rated A+ by S&P, International Bank, came to market with a 2-year note that had a yield of over 4%. That bond is going to hold up very well if rates rise for whatever reason. It can withstand over 200 basis points of higher yields, well before it'll actually lose money. That's a lot different than the kind of bonds that existed 6 to 12 months ago. That's because the starting yield is quite high. Now, when you're in the credit space, you got to do your credit homework. So picking the right credits is important. But if you can do that, you can build a really resilient portfolio to kind of deal with the challenges that we see. We've climbed a long way to price in a lot of these risks that are out there, and now seems like a pretty good time to build a portfolio that's resilient, that can handle these types of risk factors.